Hey guys, what's going on? It's your big dreamer and doer, G Dinero, coming to you today with another episode of Wealthy Wednesday. And what are we going to talk about today? Well, first, you've got to realize none of this is financial, tax, legal, investment advice. This is your buddy, G Dinero, helping you increase your financial literacy to help put you and your family on that path to financial freedom. So, what is the topic today? Today, the topic is volatility is your friend. I know, contrary to what every single investment advisor, financial advisor, whatever you want to call them, financial professional would tell you, they would tell you stay away from volatility. We don't want to go into super volatile assets because volatile assets go down just as hard as they go up, and you could lose all of your money and et cetera, right? But remember, we are carving our own path, just like a roller coaster, which you may or may not like roller coaster rides. If you don't like roller coaster rides, you might not like volatility. I love roller coaster rides. They're a blast. And so I love that feeling of euphoria when you're going up, and as you're going down, the fear that comes in, and then your stomach bottoms out at the bottom and you go back up and you feel weightless at the top. Investing is no different. And in investing, volatility is your friend. Let me show you how and why. So you can profit from the ups and downs in a volatile market. So this is a screenshot of an actual chart. This is the MicroStrategy 4-hour chart. We're looking at back to from about March the 11th or 12th until today, which is April 16th at the time this is being recorded, okay? So we're looking at about 1 month of data on the screen, a little bit over 1 month of data on the screen. And in that time frame, MicroStrategy's been as low as $230 and as high as $344, right? So $230 to $344 in a short period of time, guys, right? In a month. That's a ton of volatility. That's what makes this the incredible asset to trade with options. So today, that's what we're going to talk about. And you can see here in the screen, I said, what if you used the tools that were available to you? And there were some cues here, okay? When MicroStrategy had just made a run from about 235, 240, all the way up to $344, right? It got to 344. I'm calling that 340 because it just barely wicked above it. But what you can see is where that red circle is right there. You can see that MicroStrategy basically hit that 61.8% Fibonacci level and literally hit the brakes and turned around. And in doing so, it printed a giant red dot that you can see down near the bottom of the screen. That's the lower yellow arrow. So we're looking at selling the covered call here against 100 shares. So if you owned 100 shares, when it hit $344 a share, they were worth $34,400. Maybe you don't want to sell them because you suspect it may go a little bit higher and then pull back, and you want to instead generate a little bit of money off of those shares without selling the entire asset. So then you would sell a covered call. Then what did it do? It mean reverted straight back down again. Mean reverted meaning it pulled back, right? It had overextended itself to the top. That's called being overbought. And it pulled back. That's called being oversold, and sold off all the way back down. By May the 8th, it had sold off all the way back down to $230 a share. At that point, you decide to close your covered call and you move to a cash secured or margin secured put. We're going to go into detail on each of these in a moment here. And that would require you to have at least $24,000 of cash or available margin to secure the put side of things in case you were assigned those shares, okay? And that's where the green circle is at the bottom. What cued us in to take action there? A giant green mean reversion dot, as well as the fact that we're bouncing on the 200-day moving average. So let's dig in. Take this mental picture. I'll go back and forth just so that you have it as a guide, I guess you would say. So on March the 25th, MicroStrategy, like I said, it hit 344 to be exact. I put 340 in there. It printed a huge red mean reversion dot that was almost 2 standard deviations above the norm. I think it was like 1.5, 1.6. It also hit the 61.8% Fibonacci levels, okay? So what could you do there? Well, sell the 425 MicroStrategy 340 call. Yes, right at the money. Oh, but what if my shares get called away? Well, they're giving you $28.50 a share, which would make your break even $368.50. So if you think MicroStrategy is going past $368.50 over the next month, right? I sold it about 30 days to expiration, the 425, the April 25th. That's you saying that over the next month, you don't believe it's going to go above 368.50. In fact, you think it's going to hit 340 and pull back. That's why you're selling the covered call tight to the money or at the money, right? And in doing so, they're giving you $28.50. What do you need to have in order to pull this off? You need to have 100 shares of MicroStrategy or a Leaps, a long call. But today we're focused on what do you do with the shares that are already in your account? You sell a covered call against those, okay? So they're giving you $28.50 against 100 shares. That covers you all the way up, or a break-even price of $368.50. On April 8th, like we talked about again in the above picture right here, MicroStrategy had pulled all the way back to $230 and had been printing green mean reversion dots, but the trend finally changed directions. You'll note that all of a sudden we went from printing red candles to printing a green candle. So you decided to close your covered call, and you bought it back for $2.50 a share for a net profit of $26.50 a share. That's $28.50 they paid you up front. You gave back $2.50 of it. You've got to take that $26.50 and multiply it by 100 shares, because options are always with 100 shares. And that gives you $2,650 of pure, unadulterated, incredible profit. Basically like over 90% profit on that trade. Not too shabby. Then, like we talked about, it showed bottoming signals. There was a giant green mean reversion dot. We have the yellow line across the bottom there, and what that signifies is the 200-day moving average. So this thing's basically bouncing, and we get a buy signal also on the confluence for good measure. Whoops. So what do we do there? On April 9th, MicroStrategy dropped to a low of 230 and was 240. So it had gone to 230 on the 8th, and by the 9th, it was already back up to 240. It's changing direction. It's getting ready to mean revert, meaning it's oversold. It's sold off too hard, and it's about to get bought up and go back the other direction. It printed a giant green mean reversion dot near -2 standard deviations away from the norm. So you can use that, as well as taking a look at the fact that it used the 200-day moving average as support. Basically, it lost that 200-day moving average and quickly regained it. Notice it dropped below the yellow line and quickly jumped right back up above the yellow line. That's you anticipating that that's going to happen. And when it does, that's great for selling a put. So you sold 1 month out, again, 30 days till expiration, the 5/9 MicroStrategy 240 put, and they gave you $28 for it. By the way, these numbers are real. I know, they're real. So they gave you $28 for it. You needed to have $24,000 of collateral. What do I mean by collateral? You either needed to have cash or margin to secure the put. You have to secure the put, because if it goes below 240, you're going to get assigned those shares more than likely. And that means you've got to come up with $24,000 in some way, shape, or form to buy those shares. If you have cash in your account, great. They'll take the cash and replace it with 100 shares of MicroStrategy at 240. Again, this is if you were to get assigned. On the other hand, if you don't have any cash in your account, but you have an account that has an available $24,000 of margin available to you, they're going to loan you the money, buy the 100 shares of stock at 240, and now you've got a $24,000 margin loan that you've got to pay back to your broker. Okay, that's how that works. So your break even on this trade is 212. How do I calculate that? It's 240, it's the strike price, minus what did they give you up front? $28 a share. 240 minus $28 is 212. That's what your actual cost of those shares would be if they got assigned, okay? Anything below 212, you're losing out on this trade. Anything above 212, you're doing well. You're coming out ahead, so to speak. Well, today on April 16th, you could MicroStrategy is trading between 300 and 310, and you could buy back that put for $4 right now. So your net profit, you collected $28 a share. You gave back $4 a share to get out of the trade. Your net profit is $24 a share times 100 shares, or $2,400. Not the 90% gainer, but pretty close to what is that? Somewhere around an 80 to 85% gainer. Again, in just a matter of days, right? Not too shabby. So what's the end result at the end of the day? Volatility is your friend when it comes to trading options. Volatility, you can make money in an up market, you can make money in a down market, and the end result at the end of this entire set of trading, at the end of the covered call, your profit was $26.50, and that took place from March the 25th to April the 8th. So over the course of a couple of weeks, roughly. In the sale of the cash secured put, your profit was $2,400, and that took place. You sold it on April the 9th, and I'm assuming that you bought it back today because I'm making this video right now. I have to give you a real world example. You could wait for it to expire worthless, but let's say you bought it back today. You made $2,400, and that was in a little over a week. So in less than 1 month, from March the 25th to April the 16th, in an insanely volatile market with these crazy swings, you basically made $5,050 in this trade. You still own those 100 shares. You still have the cash or the collateral that you used to secure the put. You just flat out made over $5,000 in less than a month. Okay? That's the end result of this. So I used a lot of tools here, right? I talked about mean reversion, confluence. I talked about Fibonacci levels. I talked about moving averages, right? If none of that made sense to you, why don't you book a course with me? You can book a course and learn TradingView and technical analysis. You book that at gdinerocoaching.com. I teach a comprehensive course on that. I also talked a lot about options in this. I talked about selling calls and buying them back. I talked about selling puts and buying them back. I teach a course called Understanding Options, another great place for you to increase your learnings. And then after you've done that, or if we've already worked together, let's do another individual appointment. Let's help you go on that path to increasing your financial freedom at the end of the day. So, like this video, comment below. What'd you like best? What could I do better? I'm constantly striving to make these better and better every single time so that you continue to learn more. Make sure you're subscribed. You don't want to miss one of these videos, guys. Share it with your friends too. That's the other thing I don't always ask you to do, but share it out with your friends. Your friends are asking you, more than likely, if they know you're in the investing world, they're asking you for advice. Why not send them to a pro who knows what they're doing? A pro like me, G Dinero, who's helping you increase your financial literacy to help put you and your family on that path to financial freedom. G Dinero is out today. Go Gators, Natty Champs, got my hat in the mail. So stoked to be able to wear it today. Take care. We'll see you soon.